HIMS and hers is getting blasted in the after hours. After the company announced their Q4 earnings, shares are down, at least at the current time, down about 16%. On today's video, we'll go through a couple of different things with the company. First of all, over the past year and even year to date, shares are up big time. So the fact that they're giving back some is not that big of a deal. On today's video, we'll talk about the Q4. We'll go through it in depth. We'll take a look at the financials, look at this fundamentally, and see if this is an area where you can buy the dip in this company. We'll also talk a little bit about the future of this company, the fact that right now they're more or less a marketing company, but they are trying to turn themselves into something much bigger. So we'll talk about the odds of that happening, how this might actually impact the company financially going forward as they make these acquisitions, as they get more into manufacturing. How is that actually going to impact the financials? Because it actually doesn't show up on the financials now. So in the future, could that change things on a company that is already just fractionally profitable? Talk about all those things fundamentally, and we'll also look at this one technically as you're pulling back on this one. I think there's some clear buying opportunities for HIMS. Whether you're short-term, long-term person, there are certainly some buying opportunities. What is going on, investors? Hopefully you guys are doing well out there. Time to take a look at HIMS, which is, I had to look twice at this one. Year to date, you're up 100% on this one. Over the past year, you're up 400%. So you got a lot of rosy, touchy feelings on this one. Lots of people are going to be feeling good about this one because it has delivered. The question is, will it continue to deliver? And when we look at the Q4, we'll get into it. You had a revenue growth of 95%. So this one, when we talk about a stock like this, some people are going to talk about the multiple, that you got a $10 billion stock doing $481 million worth of revenue. But when you come over here and look at it profitability wise, just kind of fractionally profitable off of that revenue. But again, you've got a massive growth rate on this one, so it deserves that premium multiple. Also, when we look at the guidance for the first quarter, revenue expected to be between $520 million up to $540. The expectations on Wall Street, I'm seeing here at $494. Are you kidding me? So this company is doing a fantastic job, not only meeting Wall Street expectations, but they're exceeding it. Some of it has to do with the fact that it's still not a mature company from a business model perspective. They don't have a ton of analysts covering them as well. And so you don't have Wall Street coverage on this one that is equal to some of the larger cap stocks. Did a very nice job there. We also got guidance for the full year, expected to be between $2.3 billion and $2.4 billion. The expectations before the report was for just a shade over $2 billion. Even the high-end estimate was for 2.24. So the company's saying that they're going to come in at 2.4 billion on the high end. And my guess is the company is sandbagging a little bit. They probably realize they can probably comfortably come over that numbers. Well, what does it do? Brings into question next year's number at $2.4 billion. They're going to do that this year. This company's doing a very nice job. Obviously, the growth rate and the revenue growth will start to come in as the company achieves higher and higher revenue numbers. Now, from a fundamental perspective, there are some things to understand about this company. It is essentially a marketing company. And now, some people will get in my comments and criticize me for that. But if I were to do a video on Nike, for example, Nike is a marketing company that just happens to sell sneakers. HIMS is the exact same thing. They are a marketing company that just happens to sell health and wellness. And I think they do it quite well. But what you do notice is the marketing spend over at this company is ginormous. In terms of percentage of revenue over the past several quarters, it's been in that 70% range. Now it's down from the 80% range it was before the company was profitable. Still razor thin margins on this one. And this is going to bring me to my next point. You still have operating income just about 5%. In the most recent quarter, it looks like maybe it's gotten a little bit better than that, but you're still razor thin. The company is obviously continuing to scale up and it deserves to spend its money. But what it's going to get into is more manufacturing and more products and services the company has to deliver on their own. That means more facilities. That means more employees, more headaches, more costs. Now, in the long run, this could create a larger moat around HIMS and hers business, where essentially they've been in the marketing reselling business, where they're reselling someone else's product. They're reselling some other drug that another drug manufacturer makes, similar to like the GLP-1s or generic for Viagra, those types of things. That is the business him and hers has been in. And they've done a nice job capturing attention online, capturing market through very creative advertising, and they've been able to do that. Well, what they're going to get into in the future is more facilities, owning these US-based peptide facilities so they can create their own peptides, their own treatments. They're going to get into at-home lab testing as well, owning this facility. So these things are going to require more capital, more employees, more operating cost. And so you're going to turn from a marketing company to a marketing and manufacturing company. If the company can pull it off, then you've got a bigger moat and you've probably got a much bigger company. If they don't pull it off, then you've got more expenses, thinner profits, thinner valuation coming for HIMS. Now, what I did notice about the most recent quarter, what they've done a nice job is they continue to obviously increase net orders. When you increase your revenue year over year by 95%, a lot of this stuff is really just a given from this standpoint. But what they've done over the last year in particular is they've started to stretch out their AOV, or their average order value. That was up 63%, because what you've seen year over year, despite the rapid rise in revenue that the company had, near 100%, their net orders were actually up only 22%. And I say only, that's still really, really impressive. But what expanded more, obviously, was the average order value. Now, what we did see was a compression in gross margin. And this goes back to my previous point, whereas if you are going to invest in these peptide facilities and own these outright, if you are going to own a lab testing facility outright, well, that's something that could, at least in the short term, compress your gross margins. And we saw over the past year, you went from 83% gross margins down to 77%. You're continuing to spend hefty on marketing. Look at this, 125. It was over 50% of revenue. I noticed that trimmed down to a number just slightly under 50% of revenue. Total revenue 481, total marketing spend 221. I also understand that once you acquire a customer over at HIMS, there's a long-term value to this customer. So you acquire them once and you sell them multiple products, maybe for years, maybe for that person's life. That's obviously the dream with HIMS, but you have to understand there's other competitors in this marketplace as well. Will HIMS and Hers turn into the next 23andMe, which really kind of fell on its face, or will this turn into the next great healthcare company? Will it turn into a Teladoc Health? Those are all questions investors are starting to wonder and ask. Now, operation and support across the board, you're seeing an increase in expenses from 204 last year up to 350, but you did reach a turning point profitability-wise for HIMS and Hers. This is very exciting if you invest in these types of stocks. I tend to be a blue chip guy where we're printing billions of dollars of profit and cash flow, but this is what you look for with these quote-unquote smaller companies. You look for obviously strong revenue growth, which the company is ticking their boxes. They're also starting to insulate the business from a business model perspective, doing these acquisitions, doing the hard thing. This is actually hard what the company is doing because there is a decent chance of failure at these things. They continue to drive up prices and they're keeping their operating expenses, I wouldn't say in check, but notice your income from operations turning positive to $18.6 million for the full year. Looks like about the run rate, a little acceleration actually on the run rate that they were on. They printed about $62 million. Now, I know what some of you guys are going to say. If you invest in Apple and Amazon and Meta and Google, you got a $10 billion valuation on a stock that just printed $62 million to the operating income side. It's obviously a hefty valuation, but again, this stock has a massive growth rate. Also, what you don't have to really worry about, at least in the shorter term with this stock, is the balance sheet is absolutely crystal clear. I mean, this company's got a ton of cash and cash equivalents. What I did notice over the past year, you do have a pretty rapid acceleration in inventory. Some of that has to do potentially with kind of a business model shift that they're under, going from a straight marketing reseller model to where they're creating these compound formulations, these peptides and this type of stuff in-house. So the inventory did triple over the past year. So that is something to keep an eye on going forward, but it's balanced off by not a ton of liabilities. So they have almost all their liabilities balanced off with cash. So things are looking good. Now, from a cash flow perspective, I'm going to zoom myself over to the other side here because I want to show this to you. Year ended, this company reminds me of like a Palantir, some of these other stocks that we look at in this same vein. You got pretty solid net income over this company, $126 million. Now, 92 $252 million of stock-based compensation. So the executives over at HIMS and HERS, they're right behind the retail investors trying to pump this thing up because that's how they're getting paid over here. Their stock-based compensation almost matched their net income. So that's absolutely amazing. So you get to add that back in and your operating cash flow looks really good. $250 million last year was $73 million. Now, continue to invest in the business, $160 million. Property, plant, and equipment. This is the number that is going to go up as they continue to make this shift in their business model. That's the number to watch. Look at last year. They were just kind of reselling, probably buying office space, that type of stuff. Boom, all the way up to 40 million. What's this going to look like next year? Okay, so these are all the questions that investors are going to have to ask because, again, the growth rate over at this company is still going to be really good. They guided to a great number. The growth rate is still great, but the law of larger numbers is that growth rate is going to contract just a little bit. Now, what I did notice is almost dollar for dollar on the stock-based compensation, they actually rebought the stock. And so some investors will like this. For a company of this size and this maturity level, I don't like the buyback. I would rather them just keep this $83 million. There's enough retail interest and enough retail pump in the stock. I mean, when you're up 100% year to date, let alone over the past year, I don't think you need to be buying back the stock. I would bank this $80 million and then go buy more of this type of stuff and really insulate the company from a moat perspective. But look, who am I to say this stuff when the shares have just absolutely been ripping? Now, speaking of ripping, this is about as a ripping of a chart as you possibly can get. Now, it's given itself back, but I think we're in this trend right here. I'm going to scoot myself back to the other side of the chart so you guys can see this. I think this is the trend that we're in. Now, I have a line down here, the red channel, change that to a purple color. I am testing out the dark theme on the chart. Those of you that are familiar with the channel know usually go with the light theme. Now we're on the dark theme. Let me know in the comments down below which one you prefer. I think the purple is probably the longer term trend. We've kind of gone parabolic on this one. But here's your chart. You guys know I set these channels up. I tend to divide them in half. When you get to the halfway point, that can trigger a buying opportunity. I think we're coming close to that with HIMS and HERS. When you get to the middle of the channel, you can buy. With this one, I'd probably be a little conservative because as volatile and as quickly as we've gone up, I've seen these things over my 25-year career in stocks, the faster these things can fall. So I'd like for this one to get a little deeper in the channel. In the case of this stock, probably back into the 30 handle on this one. Get back into the 30 handle. That's where it gets kind of interesting because, again, I think you're going to have opportunities in this one as the business matures, as you start to invest more in property, plant, and equipment, more in the operations of the business, rather than just being a straight marketing company. I think you've got some opportunities with this one where it's going to get re-rated from an investment standpoint. Some of the air is going to get let out of the balloon, and as parabolic as the move has been, has to give itself up. And if you're in this one for the long term, that's exactly what you want with a stock like this. You want people to turn it away, just like they turned Amazon and Netflix and Meta and on down the line. Every great stock has been sold off and sold off hard. And if this is the next great stock, you actually want it to sell off hard back into the 30s, all the way back to trend, would take you back down into the teens. That's exactly what you want if you believe that this company is going to turn themselves from a marketer, reseller into a producer and an operator. I think the company actually can probably pull it off, and we'll see and monitor it going forward. Hopefully you enjoyed today's video. Let me know down in the comments what you think of this one. We'll see you again on the next one. Good luck with your investments.